Welcome to Simply Wealth, the podcast that's simplifying the complexities of your financial success. My name is Corey Cook, CEO of Cox & Cook Wealth Advisors here in Dublin, Ohio. Please enjoy the episode. All right, welcome to Simply Wealth, the podcast that is simplifying the complexities of your financial success. Today we have Dan Cox with us, founder of Cox & Cook Wealth Advisors, many decades of experience within the financial industry. Well-versed in all of these topics and anything financial. And today we're going to be diving deep into some advanced Roth IRA strategies. Roth Conversions, backdoor Roth, mega backdoor Roth. Dan, these aren't just buzzwords. These are strategies that could fundamentally change the long-term financial picture for a lot of individuals, and they're powerful tools for tax-free growth, but it's not without their nuances, right? This is a topic that we discuss weekly with different individuals that primarily have heard about a lot of these concepts through social media. It could be through a newsletter that they subscribe to, maybe even another podcast. And unfortunately, a lot of these things that they are hearing is, this is the golden rule. It's one size fits all. Everybody should be doing a Roth conversion, convert all of your money immediately. That's not the case. Everybody is unique. They have their own set of unique factors going on within their plan. So just a template-based golden rule of, hey, we should be doing Roth conversions or one of these other two strategies may not make sense for everybody. And we're going to talk about that today. And hopefully everybody gets some really good information. We also have Tom Cox with us as well, our COO with Cox & Cook Wealth Advisors, in the back, kind of our own version of Jamie, so to speak, providing us with some more details, asking some pertinent questions with us. So why don't we go ahead and jump in, Dan?
Okay. Well, I thought we'd talk about first what is a Roth IRA. That's a situation where people put after-tax contributions in a Roth account. Then they can invest it how they choose fit. We usually suggest going with a high growth portfolio, but it depends on the situation. It's also for, who is it for is a good question. Is it for everybody? Not necessarily, okay? But who it is for is young people, number one. So if you're in your 20s or 30s, starting out in your career, and you're kind of strapped for cash, boy, I don't want to put money in my 401k because I have expenses coming up, a wedding, a house or something. Well, that person should absolutely do a Roth IRA. And the primary reason for that is liquidity. So liquidity is the ability to access your money as tax efficient or tax-free as possible. So you can put contributions in a Roth IRA in that situation. And you don't want to do this, but if you had to, you could get money out of that Roth IRA tax-free, penalty-free. So every young person, if they're saying, hey, I want to put money away, but I might need it, a Roth IRA is a good thing to consider. Also, for people that are facing large required minimum distributions. So the government wants your money. They want to tax that money. And as you get into your 70s, they're going to require you to take money out so they can tax it. And so if certain clients are approaching their 70s and they don't really want to face that, or maybe they want their heirs to get some tax-free money, they can put money into a Roth to really avoid, I guess, the required minimum distribution. So that makes sense for a lot of people too, but not everyone. It depends on the situation. So a couple of examples that we've had, we just talked about this morning. There was an individual that over time was putting money into a Roth, and they decided to put all that money into one stock, a fruit company called Apple. So, right? And that company went very, very high, all right? So, and they retired, and they got all that money out of the Roth tax-free and bought the house of their dreams, okay? Mm-hmm. So that's an example of what a Roth can do, and it's really that tax-free growth that is the key.
Hey, Dan, are there any downsides to a Roth though?
Yeah, there are downsides, and the biggest downside to a Roth is you have to pay tax on the contributions or conversions, or we're going to get into backdoor Roths. So that's an immediate tax situation. So it's best that you're prepared for that, and somebody's calculated, hey, what's the estimate of that tax that you're going to have to pay. It's the old frame oil filter commercial for the old people that understand that. You got to pay me now or pay me later, and the argument is, you put money in a traditional IRA, you don't have to pay tax on that. It's tax deferred, but coming out, it is taxed. So with a Roth, it's the other way around. You have to pay the tax up front, but you get tax-free growth. So that's the differential, number one. It's also irreversible, meaning that once you do a conversion or a backdoor, you can't say, "Oh, you know what? I've decided I'm not going to do that." Well, it's a one-way street, and there's arguments too that you lose tax deferral. I kind of disagree with that because you get tax-free growth on that, so that's a problem for some people, but there's the pros are great because you get the tax-free growth, no RMDs, required minimum distribution, and it's a great estate planning tool for certain people that say, we have one client that has done pretty well in his IRA, and he has two sons. They're both surgeons. They're in high tax brackets, and they're going to inherit a lot of money, and they're going to have to pay a higher tax than he would. So we're doing what we're going to get into in a minute, conversions for that estate planning purpose. So mainly it's good for people with our clientele in a higher tax bracket where they can right now they're going to be in a low tax bracket, but later they could be in a higher tax bracket. Who knows for sure? But this is something that is most of our clients are going to use. Not all though. It depends on the situation. Like Corey mentioned, when you read something or see something on YouTube, and they say, "Oh, everybody should do this." That's not necessarily true. So a lot of people should. Depends on the situation for sure.
Yeah. And it's in many cases, how we approach it in a liquidity plan would be maybe a multi-bucket strategy, because if you're sitting with 90% plus of your assets in a pre-tax IRA, traditional IRA, you really don't have control over your tax situation down the road. It has control over you. And doing maybe not even a full conversion, but partial conversions where ideally maybe it's a third in pre-tax dollars, a third in Roth, a third in brokerage type of accounts, where you're now dealing with taxes on dividends, interest, and capital gains. You have a lot more flexibility in retirement, right, to be able to access those funds when need be, because life is fluid. You don't know when that big medical expense is going to hit, or some family emergency where you need to get access to a sizable sum of money. You can now access some of those other buckets that aren't going to be subjected to income tax. So in a way, even doing partial conversions, and it's different again with every case, relies for that future tax hedge for a good portion of that money.
Yeah, I agree. So really important for clients to start out with a liquidity plan. So you can't just have all your money in the government IRAs, 401ks. You need liquid money. That's the baseline. You need that base, and that's a brokerage account / savings account, if you will. You need a Roth IRA probably, and then you need some tax deferred money as well, for sure.
So, go
Sorry,
ahead, Tom.
real quick, you guys keep mentioning conversions and specifically Roth conversions is what we're talking about, I believe. But can we maybe take a step back and we talked about Roth basics, but walk me through what a conversion really is. 'Cause
Okay.
we're mentioning it, but I don't really know what that means.
You want me to do that? You want to do
Fire
that?
away.
Okay. So Roth conversions are really designed for some people that might be in a higher income bracket. There are limits to how much you can put into a Roth IRA if you're over a certain amount of MAGA, okay, modified adjusted gross income. And so it allows those higher income people to convert some of their 401k or IRA money into a Roth, okay? So if they want access to that tax-free growth in the future, a conversion may be a good thing for them to do.
Well, I thought you said for a traditional, it's tax deferred, meaning you put it in tax free, but then when you take it out, you get taxed.
Well, traditional is you don't put it in tax-free. Well, you do, I guess, is what you're saying. You get a tax deduction for what you put into the traditional, right? And then it grows tax deferred, meaning that, hey, you don't have to pay tax on the gain until you take it out. Okay. You know?
But then on the Roth, it's kind of the opposite, where you pay the tax for the money you put in up front, on the year you put it in.
Right.
And then after that, everything you pull out is not taxed.
Yeah.
So when you do a conversion, is that like, are you still paying tax on the money you put in, even though it's coming from that traditional IRA?
Yes.
Okay.
Yeah. So you anything that goes into Roth is taxed immediately. Okay. But then it grows tax free. So that's why, in my opinion, you want to be pretty growth oriented with a Roth, and because it's growing tax free. So makes sense.
And that brings up a good point too, Tom, is the complexity of all three of these strategies. It's not as simple as calling Charles Schwab or your custodian or whoever that may be and saying, hey, just I've got $1 million in my IRA, my traditional pre-tax IRA. I would like to convert 100,000 of that over to my Roth IRA. Right? You need to be working with your strategic partner, financial partner, wealth manager, and also a CPA to develop a strategy tax-wise, because it's not just as simple as submitting it and it rolls straight over magically 100,000 straight into your Roth. There's the tax implications. Where are you paying those taxes from? What is the most advantageous amount to convert? And there's 5-year windows that start. There's a bunch of different nuances again with this strategy that come in.
The pro rata rule is also.
So there's a lot of moving pieces with a conversion that you need to be either very well educated in yourself or have a team of people that are helping you and playing quarterback for you to develop a long-term plan for conversions if you're wanting to do so. Or if it makes sense, somebody to show you if it makes sense for you to do it, aligning to what your goals are and what your legacy plan may be, et cetera.
Yeah.
Oh,
absolutely.
Yeah, that was a good case study and good example of Roth conversions, Dan. The second strategy, if we're kind of looking at the spectrum of complexity of these three different strategies, we're going to be taking a step up slightly in complexity with something called a backdoor Roth IRA. Explain to us what that is and who it's for.
Well, again, it's for the high income earner. That's, they can't do normal direct Roth contributions. So there's a loophole in the law that allows these high earners that are phased out of doing Roth contributions, they can do what's called a backdoor Roth, which basically means that they're putting after-tax contributions in 401k or traditional IRA and then immediately converting it to a Roth, okay? And there's complications that come with that, of course, but that has to immediately be done. It's immediately taxable, that backdoor contribution is. And then you have to be wary of how much you have left in that traditional IRA, okay, because of the pro rata rule. So that may cause a tax complication that you should be aware of. So we won't get into the details of that, but a lot of people think it's easy peasy, and it can be, but the ideal client really is somebody that really doesn't have a long-standing traditional IRA. So that makes it very clean. And although there are ways around it, but the pro rata rule makes it very messy. So we'd rather it be more clean that way. Yeah.
We get that frequently, right? Where we're doing an annual review with a client or annual financial physical with a client, and we're asking our questions that we normally ask. And one of them may be the vitality of their current working income. And they tell us, hey, we have received a huge raise this year in June. And This may be somebody that's making both husband and wife contributions to the maximum amount to their Roth IRAs on a systematic basis. And, we're finding this out in November that they had this massive raise, and that income limitation for married filing jointly for 2025 starts at 236, under 236,000 modified adjusted gross income. You can make full contributions. At 236, it starts a phase out period between 236,000 246,000. You're making over 246,000 modified adjusted gross income. You can no longer make contributions at all to a regular Roth IRA. So that becomes a big issue of people not really tracking that, or they're not aware, of the income limitations within that Roth. So that's where we start talking about really this backdoor Roth strategy of saying, hey, yeah, you're out of this piece. We can do some conversion strategies, but let's also talk about backdoor Roth for you, because you've now done well in your working career and you're now making really good money. Good for you. But you would still like to participate in that Roth. Let's start making some changes, because if you make too much over the limit, you have to do something called a recharacterization, which is not fun. It's not the worst thing in the world, but it's extra work that you have to do to pull those funds back out, potentially be paying some tax on that as well. So always be paying attention to those figures, income limitation figures with Roth. Create some extra work.
And I'll add too, so we have some clients that are self-employed, and a lot of times they really don't know what they're making.
Yeah.
Right.
Yeah.
Until they do their taxes, actually. But those two, if you're single too, what's the earnings limit for that? $165,000.
Yeah.
Right.
65,000.
So if you're single and you make 165,000, then you can't do direct contributions to a Roth. You can do a backdoor though. So for sure.
Yeah.
Yeah.
So that's another strategy. And again, just to kind of reiterate, this is on the complexity level a little bit more complex than a Roth conversion. So again, having a team of people kind of helping you along the way, simplifying that complexity for you, is a big deal, and take some of that stress and anxiety off of your plate. Probably the most complex strategy that we're the third and final one is the mega backdoor Roth. Why don't you hit on that briefly?
Yeah, it's designed for the high income person and it'd be great if they were self-employed and they had a solo 401k. It makes life a little easier. But in that situation, in a solo 401k, you can contribute a lot of money to that. So 60, 70 grand more in some cases. But now you can do a mega backdoor with those contributions. It's the same thing. You do after-tax contributions into the 401k, and you transfer immediately that money into a Roth, whether it's the Roth 401k or Roth IRA, and that is taxed, but you get this tax-free growth, and you're talking 70, 80 grand in 1 year, one chunk for that tax-free growth. And again, you have to be wary of the pro rata rule. If you have any IRAs out there, traditional IRAs that haven't been taxed, that's a concern. So you have to watch that and manage that. So a lot of people that have their own business, they have a solo 401k, and they have this traditional IRA. Well, we can roll that traditional IRA into the 401k. And that kind of is a management tool that we use to kind of avoid the pro rata rule. But it's a wonderful thing. You can plow a lot of money into a tax-free environment for the future of the client. It's a great thing. So we've done several of those.
Yeah, and it's
recently.
It's right. It's definitely a niche area, because it's not just as simple as maybe I'm a business owner. Maybe I'm a highly compensated employee for a company that has a corporate 401k. You need to go talk to HR and get the plan documents to find out if your 401k allows for this. Most 401ks in general do not have provisions within the 401k to allow for the process of a mega backdoor Roth. But it's something that can change. So if you are a business owner, you are a highly compensated employee or director officer within a company, and this intrigues you, It's something to have a conversation with, right? With brass, with HR, maybe get some education, right, from a professional that's managing 401ks to talk to the company about the advantageous nature of having some of these provisions within your 401k. But it's not template boilerplate verbiage within most 401ks. You have to actually amend your documents to typically allow for these things.
And to add to that a little bit, we like doing some conference calls with the client and the 401k administrative people, and to kind of walk them through to find out, hey, can we do this or not? So
it's really value added, right? If you have a financial professional, and I'm really talking to you business owners out there that have 401ks that are already substantiated, maybe have been in force for many years. It's hopefully your partner, your financial advisor that you're working with within your 401k is bringing up opportunities like this for you, outside of other caveats like profit sharing, cash balance pension plan, all the different pieces and tools that you can add on to 401ks. They are really a Swiss Army knife. But this one's big. This one's really big and not something to be overlooked. If your financial professional is not talking to you about that, they should be, because it's an excellent tool. So,
definitely.
Corey, do you have any good examples for either this backdoor Roth or the mega backdoor? Any examples you've worked on recently?
Yeah, here in the last month and a half, we have an individual that we've worked with that has done extremely well in life. He's a wonderful guy, and he has multiple business ventures that are successful, well in the 7-figure range, on top of a very large real estate portfolio, investments and things. And when looking at his case, he's got a lot of his time and money investables into those other assets, maybe not so much in traditional IRAs or Roth IRAs. And that's one of the first things that we picked up when doing some planning with him, was that we have a traditional IRA that you have had for a number of years. It doesn't have a massive balance in it. It's actually in the tens of thousands. And so he was a unique case where, we are now processing a backdoor Roth for him to eliminate that extra outside IRA, get that converted over to Roth, and going into 2026, now putting together a plan for mega backdoor Roth within their company's 401k. And again, this was something that we had brought up. He's now seen it as well in social media and some things that he watches. Where people are kind of throwing out, hey, did you know this thing existed? We've already talked about that. So yeah, it's happening, and I would venture to say the majority of business owners, you're so wrapped up in your business and just making sure that your employees are taken care of, business is going well. A lot of these types of planning features go to the wind. Right, because it's extra work. I don't have time to mess with this. I'm running a business, a successful business. Again, having somebody there to simplify that complexity for you, bring it to the table, put a plan together for you, educate you, quickly on what the process is. It's kind of a no-brainer. This case has worked out well. This client is going to benefit immensely from these types of strategies.
And it's kind of interesting too. We work through the clients to figure out what's best for them. And whether it's a backdoor or a mega, and the distinction basically is the backdoor is like, hey, I'm going to be able to put in $7,000 or $8,000 if you're over age 50 into a Roth. A mega's going to, you can put a lot of money in there, 60, 70, 80 grand, okay, depending on the situation. So every situation's unique, and one of the best things we do is we kind of walk the clients through that whole process.
Right. Yeah. It's staggering how quick, when we talk about that liquidity plan, Dan, if those clients that may have the vast majority of their money in pre-tax, how quickly you can convert on these things on steroids, these strategy on steroids, where you can even out those buckets very quickly and put yourself in a very good spot towards retirement in a short period of time. Versus making the $8,000 contribution a year. Boy, that's going to take forever right, to build this thing up. There are other strategies out there for you.
Well, it seems like there's 3 big ones out there that you guys have covered pretty well, between the Roth conversion, the backdoor Roth, the mega backdoor.
Yeah.
All have their nuances, and like you mentioned before, definitely gets a little bit more complex. But I know we've done a really good job and a great service to the clients we do have, and in simplifying those complexities and making it easy. And I'd go out and venture to say we have a pretty turnkey process for our clients for any one of those three strategies.
Yeah.
Right.
For sure.
Right. A big deal. It's all about having that strategic partnership. This is teamwork makes the dream work. Right? We make sure that you're working with a qualified, a financial professional, and making sure that you have a very good and qualified tax professional on your team. And those two pieces should be working in tandem: your financial professional and your CPA or your tax professional. And just as a quick disclaimer here at the end of this, tax laws and contribution limits change. They change every year, it seems like.
Going to change in January.
That's right. It's going to change again coming up for 2026. So always make sure that you're verifying the latest information through the IRS, your tax professional, financial professional. And these strategies are complex. Understanding how they fit for your unique situation is crucial. And if you're considering any of these, we highly recommend that you are working with a qualified tax professional and wealth management professional. So,
Yep.
any last pieces, Dan, before we sign out?
Well, I think the biggest sign off here is it's not simple. It's not simple, and the more successful you are, the actually more complex it becomes, and that's where you need a fiduciary to guide you through these things. And we love it, because we can sit back and say, man, this client should do a Roth, and hey, this client, maybe they shouldn't do a Roth in their situation. So we love that complexity, I guess, and it's fun for us to help solve certain things for the clients, for sure.
That's right. Every individual's unique. Everybody should have their own unique financial plan.
Yeah, for sure.
Right.
Yeah.
Well, this was a good chat today, guys, and thank you for tuning in today. We'll catch you at the next episode. Thanks.
Cox Financial Group, DBA Cox, and Cook Wealth Advisors is a registered investment advisor located in Ohio. CCWA only transact business in the states in which it is registered or qualifies for an exemption or exclusion from registration requirements. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. Case studies presented are purely hypothetical examples only and do not represent actual clients or results. These studies are provided for educational purposes only. Similar or even positive results cannot be guaranteed. Each client has their own unique set of circumstances, so products and strategies may not be suitable for all people. Please consult with a qualified professional before implementing any strategy discussed herein. No portion of these case studies is to be interpreted as a testimonial or endorsement of the firm's investment advisory services.